Hello, everybody, and welcome back to another episode of the Loan Officer Wealth Podcast. We are blessed to have Ryan Stackhouse here with us today. Ryan, thank you so much for being on the show.
Absolutely. Thanks for having me. I'm honored.
Awesome. So, Ryan, you and I have known of each other and connected for, it's been years now. So,
Yeah.
I would love for everybody on the show to hear your journey in, just in general, but in the mortgage business and then to grow to what you're doing now. I think it's incredible.
Yeah. Well, I started in the mortgage business back in 2002 as a young buck at 22 years old. And, like I think a lot of people that got into the mortgage business, it wasn't like my life's ambition to be in finance or get into the mortgage business. It just sort of happened. I met a friend out of college and I went to school for graphic design. And I quickly found out when I exited college that that was a pretty tough industry to jump right into and make a decent wage. You kind of had to work your way up to being an account manager or owning your own business or something like that. I didn't know anything about, those particular facets of the business when I jumped out. So a buddy of mine owned a mortgage company, a brokerage, and said, "Hey, why don't you come shadow me and I'll pay you like a draw. And, once you get your numbers up, you're going to be, outpacing that draw with your commissions and just give it a whirl. You're good with people. You can talk to anyone and you're not afraid to jump into situations that make you uncomfortable. So come on. And so I did. And that was a fantastic experience. It was also trial by fire and, walking on coals because I had no idea what I was doing. And honestly, I'm grateful that I jumped in at that time in 2002 because the brokerage world was a much more Wild West sort of place and a lot more third party vendors and lenders at the time. And I had so many resources to get loans done for so many different people. And I was never the guy that was charging 10 points on a subprime loan or anything like that. But I had these people that were AEs that were coming in and teaching me how to sell their products. So I learned so much from those people on how to sell and how to niche their products and how to niche myself in my market and, just kind of really make, I the quote that riches are in the niches. That's really where I learned if I can specialize in something, I can be really good at this. So I started specializing with investors. I started finding investors that I really related to. I would see their books and I would do their loans and I would see that these guys were doing, owning 30, 40, 50 properties. And the guy that started the mortgage company with my buddy owned the strip center that we had our office in. So I was seeing him drive around in these fancy cars and hang out with his kids all day. And I was like, how's this dude doing it? He's like 40 years old. How's he doing this? And come to find out, it was through the passive income from real estate. So that planted the seed in my brain. And ultimately, that's what got me inspired to ultimately buy my first property for myself at 24 and then house hack that, having roommates move in with me to pay my mortgage and then move out a couple of years later, rent the whole house out, buy the next one, do the same thing over and over again. And then every year in the mortgage business, I've always been a frugal guy. I grew up in Indiana my parents were farmers and I was born on a farm, but we moved to this little town up there in LaGrange and my dad was a builder and my parents were 17 and 20 when they had me. So they were kids raising kids, and not a lot of resources. So I grew up, humble beginnings and we were frugal, we just were out of necessity. So I learned how to be frugal and how to save money and how to be smart and a good steward with what we had. And I've always been that way. I'm still that way to this day. So that kind of carried into the growth of buying rental properties. I would live for free and just pick up these properties that provided cash flow and then in time amassed a large portfolio of them. Fast forward to today, we're doing commercial because we've traded through a tax strategy called a 1031 exchange. We've been able to sell these properties without paying capital gains to the government because they give us that IRS code to do so and trade that equity into these bigger assets that are more passive that provide more passive, greater, more impactful passive income. And then along with that, learning skill sets to be able to bring in partners and investors as well and do it legally. So
that is amazing. So, as a Canadian, the 1031 exchange is something that I'm extremely jealous of, and it makes me want to get into the U.S. market more than we
yeah,
already are. But for our listeners that, and primarily we're going to have some consumers on this podcast, but a lot of them are mortgage lenders. And the reason
yeah,
why the podcast is called Loan Officer Wealth is because what we're trying to do is get mortgage professionals to the point where they're owning their businesses rather than being like the one-man band who's chasing
yes.
conditions and all of that kind of stuff. So get your marketing processes in place, get your systems and business processes in place, and then start to use the cash flow that you're getting from your business to put into investments and that sort of thing. So for those of them that don't know what a 1031 exchange is, can you explain that?
Yeah. So it is a wonderful and beautiful thing. And it's really like the foundation of our business because that and cost segregation studies, which I can elaborate on too.
Yeah.
1031 exchanges are a specific segment in the IRS code, the 1031 code, that allows us to take a property that we've owned, sell it, and exchange it for something else of equal or greater value. And we in turn don't pay capital gains on the increase in value that we have realized through the sale of that property. So for instance, to use real numbers, let's say we bought a house for 250,000 back in 2010. Now it's worth 550,000. We've paid the principal down, and now we're going to net 350 on it. Whatever gains we have from that, we don't have to pay that up to there's a right now there's no cap, but they're talking about implementing a cap. It never happened. There was a whole fear of it going away and a cap coming in. It never happened ultimately because, as we all know, politicians own real estate too on both sides of the fence. So I really sincerely doubt it's going to go away altogether. It might just get modified, but that's a side story. Ultimately, we can fold those proceeds into the next property without paying capital gains on those and realize a greater return on cash because we're not paying a lot to the government every time we transact on a new property. By, for me, it's what is my cash flow on equity? I'm always looking at that. Every 3 to 6 months, I'm looking at our properties going, what's the equity we have in this property? And is it keeping up with the cash flow? And if it's not, and it's the equity is way outpacing cash flow, it's time to sell. And it's time to put those proceeds into something else where we can realize the cash flow that we can get from that equity. Because quite honestly, cash flow is the name of the game. That is the key. If we have money sitting in the bank, it's doing nothing for us. My partner and I like to use the term cash is trash. Right now with 7% inflation, cash is doing nothing for us. In fact, it's hurting us if it's sitting in that account. So we want that money working for us, providing cash flow monthly, because quite frankly, that's what we live on.
Yep. And just to clarify in the 1021 exchange, you can also leverage that for refinance as well. You can keep the property, refi the property, and not pay the capital gains on the refinance. Is that correct?
Yeah, so that's different than a 1031 though, because in the United States, if you do a cash out refi, you pay no capital gains. You pay nothing in taxes on a cash out refi. That's a non-taxable event, which is a beautiful and wonderful thing because you can extract equity while you own the property and keep the property and keep the cash flow. If it's in a highly appreciating area and that house is going to keep appreciating. For us, an example would be our house in Nashville. It's in downtown Nashville, and that it just keeps blowing up and blowing up and blowing up. It just keeps going crazy. So we just have a first lien HELOC on that house, and we just keep raising the limit on that HELOC. It doesn't mean that I raise the loan amount, but I arbitrage that money to invest in other properties and arbitrage our equity instead of it sitting there being lazy equity, sitting there doing nothing. I arbitrage it to go buy other properties and create more cash flow and more wealth for my family. And it's ultimately about freedom, but it's also about a legacy for my kids and creating this this mindset of abundance where we can do good for other people and help other people and live in our best version of ourselves, you know?
That is amazing. And it's also a phenomenal strategy to take to your clients and your customers and say, hey, the real estate market, traditionally speaking, the greatest investment that most Americans or North Americans make. Fantastic to get in. So can you walk us through, I know you're doing mainly commercial, and I can't wait to get to that part of the conversation, but can you walk me through what it looks like for a consumer who's going out to buy their first investment property? Let's say they can access equity in their home through a cash out refinance. How much do they have to put down? Do they need an investor? What does the financing look like on buying that first rental property?
Yeah, sure. So if you're getting into residential, which I think is a great stepping stone to get into commercial, as you build equity, you can take that equity later on and trade up into commercial properties as you learn the skill sets. And honestly, like I tell everyone, the best teacher is experience. It's just getting in the game, like anything. We have to cut our teeth by skinning our knees up a little bit. We have to be involved in the game to really learn the lessons that will stick with us. And, to buy an investment property, there's multiple strategies to do it. But the traditional model is you put 20% down on a single family residence and you go get a mortgage on it. And you work out the numbers. So you figure out your cash on cash return, how quickly you're going to get your initial investment back based on the cash flow, assuming taxes, insurance, your maintenance and expenses, your management, all those costs, and you're left with the net operating income. As long as that net operating income gets you your cash back, my litmus test is 10% cash on cash or more. As long as I'm getting my cash back in 10 years, I feel like that's a good investment. The greater, the better, of course. And then there's an arbitrage model that I really love to teach to young investors. And it's that house hacking model. It's buy a house for yourself and then turn it into a rental after you've lived there for at least a year. But, some people don't want to move every 12 months. So call it every 2 years, 3 years, and then turn it into a rental. And that in that manner, having come from the mortgage background, you can put 3.5% down or 5% down and maximize your leveraging capabilities through buying a house that, didn't require a lot of cash up front. And then you're amassing equity and then you turn it into a rental, which is perfectly legal, by the way, with Fannie and Freddie and FHA rules. You can do that. And turn it into a rental and then have the intent to move into something else to step up. As long as your initial intent is to occupy the property, you can turn it into a rental later on.
And that's a huge tip because owner occupied, like you said, 3% or 5% down, as opposed to just going out and buying an investment where you need 20% down. It's leveraging your cash.
Yes.
Fantastic. So what markets are you in? Are you finding, are you investing all over right now? Are you still investing in residential? Are you purely commercial right now? What does that look like?
So we do invest in some residential, but it's mainly vacation properties. It's vacation rentals. So right now I'm sitting in our house in South Padre Island at the very bottom tip of Texas, almost at the border of Mexico. It's at the very, very bottom tip. And we're down here for the winter because Colorado right now is like negative. I woke up the other morning, it was like negative 30 and, 4 feet of snow. And I was like, nah.
Yep.
I love to ski as much as anyone, but not negative 30. So we have this property. It's actually a duplex. I'm down in the downstairs apartment. It's a 1-bedroom apartment downstairs. The upstairs is a 2-bedroom with a fold-out couch. So we can sleep a total of 14 people in here. We've got a heated pool and a hot tub in the backyard. We've got water, bay view out the back or the side yard. And this is a vacation property for us when we're not here. We arbitrage this by renting it out from, April till October when we come back up here or come back down here. And during that time, our gross income is 120, 130,000, and our mortgage payment with taxes, insurance, and everything is about $4,000. And we've got utilities of about 1,000 a month with heating the pool and all that. And, $5,000 to make, we take 30% off of that for management expenses, but still to arbitrage and make, say $30,000 positive cash flow on a property that we get to use for free, because we're making positive after we pay the bills and stay here for 3-4 months. And we're creating equity too, because this area with Elon Musk down here doing SpaceX and all this stuff, he's buying up land. It's also an equity play as well. And by we put in the pool, we've done improvements to the property, so we created a bunch of equity. So for us, these vacation properties that combine with lifestyle assets have been a good move for us. And my friend Erin Bradley, who I think you might know through the Freedom Club, she was in there at the same time that I was in there. They bought a fourplex right across the street from us and did very well on the purchase price. And they're creating a ton of equity in their property doing the same sort of arbitraging.
That is amazing.
Yeah. Yeah. So those are the residential properties we're buying. The rest of them are commercial, but we do buy vacation rental assets that are good equity plays along with cash flow plays.
Do you find that you make a lot more cash flow on the short-term rentals compared to having longer-term rentals in, say, your more traditional, like a fourplex with just like standard tenants?
It depends. I mean, for some fourplexes, you can definitely make more consistent cash flow, and it may average out to be similar to the Airbnb or the short-term model, but there's no personal usage aspect at all.
Right.
You have no flexibility to be able to use that property. And like their property is a fourplex, they can rent out all the three other units full time and just use one of the units and arbitrage that one, and still, more than cash flow, more than pay for their asset, create equity, pay down debt, and have a really good model with that. So it does depend, but the thing with vacation rentals is they're seasonal. So you have to plan for, basically what I tell people is collect all your money in the busy months, collect it in your accounts. Don't pay yourself until you go through the cycle of the slow season and figure out what those expenses are going to be, and then figure out your averages over time and then pay yourself, Yeah,
that's super helpful and a great tip. And so moving forward, so you talked about you leveraged your portfolio, you moved into commercial. I've always heard, and I'm a firm believer of try and do the biggest deals that you possibly can.
Yep.
And so talk to me about what happened. Why did you decide to go to commercial? Why are you there now? And then let's talk about attracting investors and how you're putting these deals together, because some of the pictures that you've posted just in the last month, you're doing some mega deals on some mega properties. I'd love to hear about the journey to that.
Yeah, sure. So what really inspired me to do these was I went to a conference, and it was an apartment syndicator that actually was putting on the conference. And I started, I love learning. I'm a lifelong learner. I love to read books. I love to go to conferences. I mean, that's where I met all you guys Carl White and Tammy and Irene and all the wonderful people that are a part of that organization, and and all the loan officers across the country. That's the thing I miss the most about the mortgage business, is that community. There's such great people in that community. And so I went to a conference. I learned through arbitraging these bigger deals that there were more tax benefits. There was obviously more cash flow. There was more you could do with, bringing in other partners and investors to be able to take down these bigger deals. So for me, it started with looking at, okay, I'm 11 years into investing. Maybe I was 12 or 13 years into investing at that point. So I had a bunch of equity built from these properties that I owned. And we were at like 34, 36 units at the time, being 11, 12 years in. So I was sitting on probably 2 million in equity in these real estate properties that were making me in cash flow, maybe $5,000 a month in cash flow, positive cash flow. So obviously the equity was not keeping up with the return on cash flow. So I looked at that. I looked at the model that I was being taught, and I was like, man, if I sell these and leverage these into these bigger apartment deals, I can make a lot more cash flow and have all the maintenance and expenses under one roof or two roofs instead of 34 roofs, right? So for me, it just started out as like, this is a more efficient way to do this and scale under one roof as opposed to a lot of different roofs for management, for arbitraging, for the economy of scale, for all of those things. And then I started learning about, cost segregation studies, being able to front load depreciation to offset your capital gains and offset your cash flow. I learned that strategy. And then I learned about, arbitrage.
Sorry, Ryan. Can I stop you right there?
Sure.
That was a lot for people that haven't heard of any of that stuff. Can you unpack that just a little bit for our listeners and for me?
Yeah. Yeah. So specifically, what would you like me to unpack?
So taxes are also always a huge issue. So you talked about front loading tax benefits on buying a larger scale property like that. How does that work?
Yes. And yeah, in the mortgage world, most of my friends and I was W-2'd. So that was a large tax liability for me. And every year I was trying to figure out ways to get money back from the IRS that I'd paid through my W-2s, right? So by owning these, and I'm not saying single families are bad, you can still cost segregate those. They're just not as efficient as bigger commercial properties like apartments or like what we're doing now, these industrial, medical, telecommunications, triple net lease buildings. When you have bigger properties with more square footage, more components, larger roof space, square footage of shingles and HVAC units and all these different things, you can essentially, the government allows you to do a cost segregation study. And we use a cost segregation engineer that we employ, and he charges anywhere from for a smaller property about $2,000, for a larger property about $5,000 or $6,000 to do a cost segregation study. But that equates to, if I pay $6,000, I'm getting like 85, 90,000 in depreciation that I can front load. And if I don't use it all, I can roll it over to the next year. So what that means is if I have a capital gains bill on my adjusted gross income line at the bottom of my tax returns, if I've got a bill there, and let's say I'm normally going to write a $34,000 check because of what I've made, that wipes that out completely. And I can carry over what's left over to the next year and wipe out that next tax bill. So, our strategy every year, my business partner and I, is as we're growing this wealth, as we're growing our cash flow, as we're growing it for our investors and our people, that we have investors now that have become financially free through the deals that we've done because we've worked on several deals together, and their passive income has replaced or kept up with what they were making before. So they've left their day job. So our strategy now becomes their strategy, and we work together to create a strategy where they're not paying capital gains as well. So by doing that, front loading the majority of that depreciation, we're able to take advantage of that tax law and offset our capital gains. So we're not paying taxes on our cash flow, and we're not paying taxes on, any capital gains that we have. And then that carries over, for usually we can stretch that out for about 5 to 7, sometimes 10 years. We've still got more depreciation that we can keep depreciating. Traditionally, a residential property has 27 and a half years of depreciation per the IRS code. In commercial, it's 39 years. So who's going to own a property for 39 years? I'm not,
Yeah.
There's no way. I'm always going to maximize that equity and the cash flow instead of just letting it sit there and be lazy equity, right? So by using that depreciation to our advantage and using more of it up front, we offset our income, and we're able to offset the income for our investors as well. And they share in those depreciation numbers on their K-1s that pass through to them on their tax return, their personal tax return. And then we offset their capital gains on their W-2s. So it's a great way that we can all work together and come up with a tax strategy. And then when we've exhausted that depreciation, we sell, we 1031 exchange into something else. We don't pay capital gains again, and we start the process over again. We do the same thing over again.
That is amazing. And I'm assuming that the deals just keep getting larger and larger because you have a larger equity built from the cash flow that you can
They
equity and
do.
cash.
Yeah, they do, because as we scale and as we create more equity, the deals get a bit larger. But we're also trying to, like, diversify and leverage risk as well. So our sweet spot's kind of in the 2.5 to 4 million range for buildings. If we start exceeding that, we'll probably start considering splitting it up to two $4 million buildings, or, you know, just so we're not hedging all of our money in one large single tenant asset that, could be a huge expense if we have to refill that building. There's a vacancy for 6 to 12 months, right? We're just
Right.
diversifying and spreading that risk around. So,
Okay. Awesome. And then can you talk to me about your journey of going to, obviously starting with the individual units, but then it sounds like you did a couple of apartment buildings, and now it sounds like you're looking at like large triple net leases. So can you talk me through that process of how you grew?
yep. So the first property, like I mentioned, was a property that I bought for myself, and that very first property was 117,000 US back in 2002. So nothing fancy, just a very functional suburban home. And I rented that out, and then I started buying duplexes, triplexes, and quadplexes. That was my main focus. And then once in a while, single family like foreclosure would pop up around 2008, 2009 time period. So I'd pick up for a couple years there a bunch of really good foreclosure deals that created a lot of equity as well. And then kept on that plan of duplexes, triplexes, and quads as my main focus. And just with the main focus of creating cash flow. And then at 2011, I moved to Nashville, Tennessee from Indianapolis, Indiana. That's where I got my start in the mortgage business and started buying properties in Indianapolis. And when I moved to Nashville, my timing could not have been better. I like to say, I got really lucky on the timing, because I had no idea what was about to happen to Nashville and what was happening at that time. Nashville went through a giant growth spurt and gentrification period. And I started buying up properties in these areas that were going to be gentrified, and essentially, bought a fourplex, bought multiple single families, bought lots, and I built houses on those lots, many times over, and eventually created some of these tripled in value in 5 or 6 years. I mean, just insane numbers, like
Wow, that's
just,
amazing.
yeah, stupid numbers. So I really, really got fortunate with the timing on that. And, I would say this, that the biggest lesson from that for me is, like, we can't chase those things. If they happen, they happen. But if we use data and empirical data, and we use, predictable numbers and data, we can accurately predict when growth is going to happen, but we can't predict when tripling values of homes is going to happen. Sometimes we get lucky, and we get lucky by being in the game, by doing this, by taking
That's right.
action, right? Just like in the mortgage business, you don't get lucky. You put in the work, and then, you know, every day is lucky because we put in work, right?
That's right.
So, so at one point, back in like 2015, 2016, that's when I went to my first apartment conference, where I learned about the economy of scale of apartments. And that's when I started selling off chunks of my portfolio, in threes and fours, to invest in apartments. And I would do 1031 exchanges with those three or four, move it into a $1.5 million asset, and then consolidate into one bigger asset, right? And so I did that for a few years, and those apartments around the Nashville area skyrocketed in value. So we again rode the wave of, giant equity gains in those apartments, and then we sold those. And then we started learning about triple net lease and absolute net lease properties, which is mainly what we focus on now. And the way we hedge inflation, the way we hedge risk on those, is we buy assets that arguably COVID was a great test for the most awful recession we could possibly have, right? We found out what businesses are essential and which ones aren't, and which ones are going to pay their bills and which ones aren't. So we found out that, strip centers, retail strip centers are heavily affected by recessions, and medical centers, telecommunication centers, and essential industrial businesses are not affected by recessions. We need those services as consumers, as Americans that tend to have, baby boomers that are going into their golden years where health is an issue. So if we buy buildings with lease structures where the tenant pays the taxes, the insurance, the maintenance from the walls in, all we as the landlords are responsible for are the roof and the parking lot. And if we set aside the reserves to maintain those, we have very predictable income and very predictable expenses. And we have tenants that are, for all intents and purposes, recession proof, and we can predict that they're going to stay in business and pay their bills through any ups and downs and any influx in what the market is doing. So that's what we're focused on now. It makes our accounting easier, it makes our cash flow easier, and we essentially now do about 60% of our deals are funded with our own money. My business partner and I kind of do everything 50-50 now. And we pool our money together. He's a Nashville guy as well. His wife's a songwriter and very, very successful guy as well. He was a realtor. I was a mortgage guy. That's how we met. We worked together.
That's so cool.
Yeah, that goes back to the mortgage business. We were working together, so we built that trust by partnering, referring business back and forth. And essentially we partner fully now with our coaching. We coach on this stuff. We teach this stuff. And then we pool together our resources to raise money with investors. And about 40% of our deals are bringing in investors and partners to do these big deals, like some of the closings you've seen recently.
That's amazing. So I want to be respectful of your time, Ryan, but I would love to hear that side of things. Like, how are you going out and getting investors? Have you built those relationships? What does that look like?
Yeah, sure. No, and I'm good on time, so happy
Okay,
to
great.
happy to dive in as much as you want. Um, so basically, being in the mortgage business was a huge boon for my building of trust with people, and I don't take that lightly because, I was their financial advisor. I was their guide, through some of the most important aspects of their life, right? Buying a home arguably is our biggest investment in life, and you're building home there. You're building your family there. So a lot of people that I worked with, they saw what I was doing. They saw that I was investing in properties. They saw that I was doing development deals and then eventually buying apartments. And a lot of those people I've given advice to through the mortgage business, and I've just shared my experiences with the properties that I bought. They've gone and done their own. And for many, many years, they kept asking me, man, can I jump in with you? Can I just partner with you? And I was like, no, 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 no. I don't want to do that. I don't want to take other people's money. And through educating myself, through learning from mentors, through learning from attorneys, and just diving into learning securities and exchange laws and rules, mainly through our expert attorneys that we have. We've learned how to syndicate, how to bring in investors, how to properly disclose things, how to properly advertise things, what data to put in there, how much data to put in there, all of those things to scale it to the level that we're at now. And honestly, the way I've grown that investor pool has been, Carl White always said, your evidence of success that you post on social media will attract clients and will attract referral partners. That's really
Yes.
been a huge thing for me. Number one, getting on social media and educating people, sharing my experience, adding value to people's lives, just giving them tips and trying to inspire people. I'm really passionate about inspiring people to get started in this because it created the life that I have now, this is my dream life. I'm living my dream life. On my deathbed, I will look back and say, there may have been a few things I screwed up on, but I'm really living my dream. I really lived my dream life. And
That is amazing.
I think that, people see that, they relate with that, and then they're drawn to that. So they reach out to me and go, dude, how can I do what you're doing? I make a lot of money, but I don't have the time to dive into this stuff. So how can we work together? And sometimes it's a good personality fit, sometimes it's not. We have to align as far as our goals and lifestyle and all these things. I'm not a suit and tie guy. I'm never going to be. I'm not a, I'm mostly barefoot, quite frankly. I'm down here in South Padre. If I'm up in Colorado, I've got hiking boots on, but I'm barefoot down here. But I work hard. I know work ethic, and I know how to be fiscally responsible. So my investors and partners, and my business partner and my wife, they all know that I'm taking care of business, and I'm doing what I need to do. But I attract like-minded people that want a lifestyle that's more holistic and more in balance with what they want to do. It may not be travel, it may not be all the things that I like to do, but maybe they want to, just first and foremost, spend more time with their family. Maybe they want to be home with their kids more, and
That's
let's
right.
start there, right?
Yep, I could not agree with you more. And that whole lifestyle part of things is why we do the podcast. You might be able to hear
Yeah.
the motorcycle in the background because you know, we're traveling, we're remote, we're doing this, you know, all aligning with exactly with what you just said. So
Yeah.
it's powerful stuff. It's not just about the money. It's about
No.
being, being able to have that lifestyle that comes along with it.
Yes.
So
100%.
in today's market, one of the things that's a huge pain point, I think, in the real estate market right now is availability and being able to actually find a property, win a property, market a property. How are you finding these deals? How are you finding these properties, and what does that look like?
Yeah, great question. So a lot of the deals we come across are truly just, like in the mortgage business where we develop trust with referral partners. This is a relationship. All of real estate is a relationship game. I've built trust with these brokers that, when I'm teaching my students about how to find deals, I'm telling them, guys, it's not about the deal that's advertised on LoopNet or CoStar or all the commercial listing, or let's call it the MLS, right? It's about the deal behind the deal. What does that agent know is coming to market and is not listing? That's where the real money is made, and where the relationships take us are into those places of trust where they feel like they can give us those pocket deals and get those deals done. So, the majority of our deals come from brokers that are in the markets, saturated in their markets, that are hustlers. And we have refined our criteria so tightly that they know exactly what we want, exactly what cap rates we want, exactly what returns, tenants, lease structures, all of those things. And to answer your question before, we're buying all over the country, but mainly we buy in pro-business states, which are, no income tax states, or at least states where we as the landlord have more rights than we would normally have in, like, say, California or New York,
Right.
where those states. I've owned a hotel in New York. It is tough to do business there.
Yeah.
They're making it very tough to do business there and very expensive to do business there. So for us, we invest in Tennessee, Texas, Georgia, Alabama, Indiana.
Nice.
Those are our main states that we have most of our holdings in. We're about to buy one in South Carolina as well. Um,
Nice.
it has nothing to do with politics or anything like that. It just has to do with what rights do we have in those states, and are we going to pay a ton of taxes, and what's the growth look like in that state? It tends to be in pro-business states, more businesses move into those, which equates to more jobs, which equates to population growth, which equates to higher median incomes going up and populations growing. So that all equates to good things for real estate.
That is amazing. Well, Ryan, thank you so much for taking the time and for sharing with us today. And what an incredible journey. Congratulations on your success. That is just fantastic.
Thank you so
Um,
much. I'm honored to be on it. And thanks for having me.
So loan officers, investors, people that are following me that are interested in that lifestyle side of things, how do they learn more about your real estate course? How do people get a hold of you? How do people move forward with you?
Yeah, so we have a website called Cash Flow to Freedom Academy, and it's at www.cashflowtofreedomacademy.com. And I'm on social media. It's just Ryan Stackhouse on Instagram, RL Stackhouse. Find me on there, DM me. I'll gladly set up a call. I tend to be pretty generous with my time. I protect my time with my family, but I love to talk to people. I'm a relational person. My wife jokes she's an introverted extrovert, and I'm 100% extrovert. So, for me, I recharge with people. She needs recharge without people. I go anywhere and make friends anywhere. I'll stand and talk at the hardware store for 40 minutes. So people can reach out to me. I'll talk to them. I'll explain what we do. Again, I'm about as low pressure as they come. I've achieved what I set out to achieve. So I'm perfectly content where I am, but I can't, I'm the perfect example of telling somebody, like, be careful what you wish for, and don't expect, if you retire early, to do nothing and to sit on your thumbs and go drink Mai Tais on the beach. I tried
That's right.
that. It is not fulfilling at all.
Yeah.
Drinking the Mai Tais on the beach is fun for about a month. And then after that, it's like, all right, I am doing nothing with my life. In fact, I'm probably going backwards in life. I need to find productive ways to still grow as a person, help other people, feel like I have a purpose, and contribute,
That is so true. And it's amazing to see you, I think, finding your calling and moving forward on this path. One final question. There's a lot of people that have done really well in the mortgage industry over the last 2 years. Are you
Sure.
currently accepting investors?
We are. So what we tend to do is we tend to buy about 3 to 6 commercial properties a year. And when those deals come up and we get them under contract, we put together a slide deck with a syndication offering, and we'll send those out to investors. So we definitely are. It's all based on timing. So when we find the next property, we're trying not to rush into the next property. We want to find the right property with the right tenant, the right returns, the right lease structures. But the short answer is yes, we are.
Perfect. That's awesome.
Thanks
And I'm
for
sure
asking.
people can find information, no problem, and reach out to you directly. In the show notes, we will have all of Ryan's information and ways that you can reach out to him, as well as the website as well. Don't forget, if you enjoyed this episode, hit us up with a 5-star review on iTunes. And Ryan, again, thank you so much, brother, for being on the podcast.
Thanks for having me. Greatly appreciate it, and I'm honored to be on here.
Hey, it's Chris Johnstone. Thanks for listening to another episode of the Loan Officer Wealth Podcast. I hope that you loved it and got incredible value from it. Right now, it's time to head on over to iTunes and leave your 5-star review if you enjoyed this episode. When you do, you will be entered into our monthly draw to receive an Amazon gift card. So go ahead, leave that review today. It also helps us attract top talent and really get incredible interviews lined up for you so that we can share even more value for you. Now, for the show notes and for all of the resources that were mentioned in this episode, you can head on over to loanofficerwealth.com. That's loanofficerwealth.com. You get access to all the show notes from all the episodes, all the past episodes, get notified of new episodes when they drop, and we've also got some very special bonuses for you over on that page when you opt in. So head on over and opt in today, and we look forward to sharing the next episode of the Loan Officer Wealth Podcast with you soon.